Hello everyone. I hope you can hear me fine. Just getting in a bit early, just giving it a minute or so. Testing the mic. Hello Larry, I hear you. Sorry, I could read your chat. Perfect. Aaron, I see you. Doing well. Good. Sound check is good. I presume you can see the video as well. Ricardo, hello. Thanks for joining. Just gonna give it a few minutes till everyone starts coming in. Awesome. Okay, so we're right on the dot at 8 p.m. Eastern. Welcome everyone. Welcome Simon. Welcome Josh. Thank you for joining this Saturday evening or night, if you want to call it. I appreciate you all coming on, joining me. Wow, has it been a pretty, I would say, eventful week in the markets. Antonio, hello. Chandu, hello. Thanks for joining. I'm gonna kick things off shortly. Just kind of just waiting a little bit just on the last few people to come in. And we will kick things off, okay? I appreciate everyone getting here on time, getting here and being a part of the conversation, the chat room. Keep in mind the chat, I will keep an eye on it once I'm done covering what I have on the agenda. Then we'll go into the Q&A, okay, to really answer questions. And keep in mind, I'm not going to answer any redundant questions, something that I've touched on multiple times before, because time is of the essence. So let's kick things off. I want to talk to you guys about the market environment, what's occurred in markets, what's happening, where we are, and where we can potentially go this week. Today is Saturday, March the 6th. Okay, it's 8 p.m. Eastern, and I have brought up the exact chart with the exact lines. Okay, very important for you to know. I brought up the exact chart and the exact lines that were on. The two red lines, they were on last week. I put them on last week live on this similar YouTube webinar. You can actually go ahead and watch it later on to confirm if you don't believe me. These are the same lines on the same spot. I have not changed them. Take a look at where the S&P 500 bounced up from. Okay? Just draw your eyes to that level right there. I want you to take a look at it nice and clearly. All right? This line was drawn a week prior. Okay? Last Saturday, 7 days before. Take a look on Thursday. Okay? We had the S&P 500 index, as we're looking at here on the daily chart, dipped below. Okay, it did dip below on the intraday, but closed literally 7 points. 7 points off the level that I had identified and said would be a crucial point last week. All right, I'm not saying I'm Nostradamus or if I can tell the future or anything. I'm just merely sharing to you my expertise. And hopefully by now, if you're watching or if you're new, or maybe you're completely clueless as to who I am, I'm hoping you have an understanding that this is not something that is just guesswork, or this is something like taking a random stab in the dark. There's work, experience, effort, due diligence done to this, and this is right in front of you. You can verify and see it yourself. The 3760 level is not a secret. I said would be a key zone to keep an eye on. In fact, we dipped below that level on the intraday twice, on Thursday, okay, Thursday and Friday. Yesterday, March 5th, we dipped below that on the intraday because we had a massive day on Friday. We had where markets went low in the red and then essentially had a very, very bullish afternoon, right? On Thursday, similar story, except it closed a little bit higher than where it went to the low of the day. This level, this 3760 level, is still in play. Okay, it's still in play. You can't see it here because I've kept the chart clean. There's no indicators on the chart, only these lines, and there's no alpha cross evo. My indicator is not on here. Nothing is on here. But on the 26th of February, okay, on the 26th of February, this day, if we had the alpha cross evo up, okay, would be where we would see a short signal on the market, okay, or a bearish signal on the market. That signal is also still in play. Remember, that indicator although it's proprietary and doing a lot of math and data crunching in the back, it's not some crystal ball, or it's not some kind of get rich quick thing, or it's not 100% accurate thing. There's never 100% accuracy in the markets. Okay, that's just it's next to impossible. So the reality is that it's a probability type of game. It's a great indicator. I use it all the time, but just for cleanliness and keeping it simple, I don't have it on the chart. But that short signal is still in play. What does that mean? That means the market environment on technicals standpoint is still bearish, even after a Friday, very bullish close on Friday. In fact, we've seen a very bullish close on March 1st, right? I think that was March 1st was what, Monday? Yeah, on a Monday, right? We've seen a bullish candle like this on Monday where we thought, you know what, we've gone past this dip. Well, not quite. In fact, markets dropped lower. We've got a relief rally. I call this a little bit of a relief rally, or maybe if you want to call it a dead cat bounce for now. But that's what we have on Friday. Okay, where are we going to go from here? Before I do, I want to bring up the NASDAQ. Okay, we'll bring up the ETF on the NASDAQ. Okay, instead of the index. Here's the NASDAQ index. Okay, this is the QQQ. This is the ETF that tracks the NASDAQ index. This is down. Okay, roughly 10% from the highs. So you can say the NASDAQ, which is the tech derived index, after Friday it's recovered a bit, but early Friday it was looking really bad, and Thursday especially it was looking really bad. It was down about 10%. Okay, it was down about 10%. 10% is not a crash from the highs. It's a correction. This is healthy. This is perfectly normal. It's not something we haven't seen before. In fact, you don't have to go too far back. I mean, March was last year was a significant pullback, right? If you recall, we traded that very, very well. I'm not saying we're gonna have a similar pullback. In March last year in the NASDAQ, okay, remember tech focus index, we had about a 30% pullback from the highs. Okay, I'm not saying we're going to see a 30% pullback. A 30% pullback on the NASDAQ would bring us down to, levels where it would be something that would kind of be quite painful for people to see. I don't think we're going to see that at all. Okay, I'm just giving you an idea as to where 30% would be, and it would kind of end us up back to July levels in the NASDAQ. I don't see that happening. Okay, but with that said, this is the tech index, okay? The S&P 500, I look at the S&P 500 as a broader benchmark. This is a more representative of the U.S. Stock market as a whole, and that is only down 2.6%. I love how everyone is, getting scared and losing their shit and, getting stressed out and all this stuff, especially on social media and just panicking. It's the 2.5% drop in the U.S. broader market. Yes, individual stocks are down more, especially if you held like things like, these EV plays and these hype companies and these SPACs. Like, I'm not surprised at all that they got dumped. In fact, this is a healthy part of the market. When everyone starts making money so goddamn easily, you have to be careful. And I've been saying it for the past few weeks, until the beginning of the year, because I said, you know what, things are very frothy and things are looking quite excessive, where any Tom, Dick, and Harry was just throwing money. In fact, look at the meme fiasco, right? Like GameStop, AMC, Nokia, BlackBerry, on and on and on, right? What does that mean? That's making a mockery out of the fundamental structures of the market, and it doesn't take a genius to know that that doesn't end well. And here we are, right? Here we are. You'll probably notice that when companies, when something like GameStop, usually before, when it kind of goes up, not surprising to see that when GameStop squeezes higher, markets go down. Okay, it's a bit of a correlation, not enough sample size to be saying that it's a strong correlation, but there is a bit of a correlation there. With that said, where do I see the markets going? Right now, I can tell you what I'm doing. I continue to hold positions in things like Walmart, Costco. I have positions in Apple. Okay, list these down if you want, because it's not often that I open up and show and share my positions. In fact, I've done that in a few videos, but I'm telling you right now, some of the prominent positions I hold. I hold, I've mentioned a few, Pfizer. I have some Procter & Gamble. I have some GSK, GlaxoSmithKline. I have some Merck. right? Who is working with J&J to distribute the vaccine. That J&J's vaccine just got improved recently. So I have a lot of these fundamentally sound, amazing companies that are not going anywhere. So I don't set hard stop losses. Remember, I don't have hard stop losses on these stocks that I hold. Okay. In fact, the last 3 to 4 days in the past week, I didn't take much new positions, only a couple speculative ones, but that's it. I didn't take any major positions because I slowed down on my trading. I've pulled back on the position sizes that I take and really just taken a longer term approach on this in this environment, because that's the kind of environment, that's the kind of situation that you need to implement. You have to think of it as not a quick and turn around, because we know the markets can be very volatile. Just look at these two candles on Thursday and Friday. This candle and the wick tells you that there's a lot of indecision. This is the S&P 500 index. Okay, this is not a neo stock or a SPAC or some whatever the hell else people are trading nowadays, trying to get rich quick, right? This is not one of those. This is the index as a whole. And when you see this kind of volatility intraday, that's something you need to be very careful of, because you're going to get whipsawed. You're going to make money, lose money, I would say, intraday. And I'll tell you right now, any day trader out there that's trying to tell you they can trade this market and make money consistently is a fucking liar. All right? Is a fucking liar. There's maybe one or two out there that will document it and actually be legit. The rest are all fakes. They're all pretending, and they're all pretending to be something they're not. No one is consistently being able to day trade in this kind of market and make money without getting their ass handed to them. All right. So I'm not even going to go into the day trading route. I don't day trade. In fact, I swing trade and invest. Okay. Those two are the perfect combinations, using stocks and options. All right. With that said, continuing on, where do I see markets going? Here is my projection. Remember, I cannot tell the future. I'm simply using my experience, my thought process, my insights. Can I be wrong? Abso-fucking-lutely, I can be wrong. Okay, so here is what I think we could see. We could see the market pull back lower to this 3760 area. Okay, remember, this is not a precise metric, although it was very bang on, 7 points. Okay, about 0.18% off the target. Okay, of Thursday. That's where Thursday closed. 0.18% from the level that I identified. I think we can see a little bit more of a pullback. Okay, to 3760 area. I said this before last week, and I'll say it again. The market is a bit spooked. Why is it spooked? Why am I saying the market can pull back? Because we've had these companies, primarily tech, these growth companies that have gone insane. They've had a wild ride where someone just throws money, okay, at some of these SPACs, at these crazy mid caps, these crazy EV plays, these crazy solar plays, so on and so forth, and they just make money hand over fist. No due diligence required. You can just go on Wall Street bets and buy whatever the fuck you want and make money, right? Well, guess what? They only last so long. So the market is not going to tolerate that. And why is that? Catalysts have to happen for things to shift, and catalysts have been happening. For example, we have potentially come to an agreement, an understanding, even from the Federal Reserve Chair, Jerome Powell, that we may see an uptick in inflation as economies open up, as spending ramps up, as stimulus trillion, okay, frankly, a $1.9 trillion stimulus is put in to people's hands and different businesses and so on and so forth. And I bet you that's going to factor in inflation. In fact, I believe that inflation isn't completely calculated on the CPI index. It's not accurate, okay? It doesn't take a genius to know that over the last 5 years, few years even, things have gone up in price. So keep in mind, the market does not like an increase in inflation. How can I come to the determination that we're seeing inflation higher? How can I come to determine that the money supply is changed? We can take a look at the Treasury bond yields. Take a look at what happened. Why did markets go lower this week? Okay, because the yields went higher. We had a couple good days, right? We had a couple good days on Monday, Tuesday, so on and so forth, because the yields dipped lower in the beginning of the week. Everyone was celebrating. Great, okay, maybe we bought the dip. Not quite, because the yields continued to move up. In fact, where everyone was panicking at 1.5, okay, the yields closed on Friday at 1.55. Okay, 1.55% for the 10-year Treasury bond. Okay, this is continuously moving towards a 1-year high. This is not looking ideal for markets. When we see this, there's fears of inflation coming in. Fears that the growth that has been baked into the markets, especially these growth stocks, may be overdone. This is why you're seeing tech stocks, primarily these high-flying growth stocks, get demolished, get absolutely demolished, because growth comes at a cost. The cost of that growth has to do with borrowing, leverage, has to do with liquidity. And when that goes up, when it takes more money to generate $1, meaning the cost to generate $1 in revenue is higher, aka the cost of borrowing, guess what? The markets are going to be apprehensive of that. And that's what we're seeing. We're seeing a bit of a correction primarily derived by tech, and that's weighing down the rest of the market. I identified to you in the NASDAQ was down about 8.5% from all-time highs. In the similar time, the S&P 500 is down about 2.8%. That's a big difference between the broader U.S. market index and a tech-focused index, right? So we can easily determine that tech is what's driving this sell-up. Now, what I recommend doing now is, at this point, when we see a 10% drop in tech, there are some great potential buying points that have already opened up. I'm not going to list. I've already given some great trade ideas last week. They're still in play. You can still get in. In fact, you can get in at better price points now. Can markets continue to go lower? Yes. If we see the Treasury bond go up, I assure you, markets will continue to puke, especially the tech sector, because growth valuations will need to come down as the cost to retain that growth in the stock grow their revenue, okay, grow their investments, grow their book of operations, grow the business itself becomes more costly. Okay, this is what people don't understand. Why have value stocks done well? In fact, my portfolio, one of my portfolios, okay, the long-term investment portfolio, it was up on the last few days, even though the market's pulled back. Why? Because we've seen value companies not just drop significantly, they've been holding with a slight uptick. You don't have to, go too far. Take a look at what's happened in some of the pharmaceutical companies, right? Like, take a look at, Pfizer. See this uptick moving in. Okay, it's not a secret that I have Pfizer. I've said it before. Right, and I've said it and shared it publicly a couple of weeks back. You don't have to look too far to see that some of these companies are ticking up in a market that's dropping, right? Pharmaceuticals, banks have also, right? XLF is the financial ETF. Take a look at XLF. Okay, wow, it's moving up. Why is it moving up? Because yields are going up. Okay, when yields go up, banks effectively make more money in interest, right? They make more money in interest. Mortgage rates go up. So this is what I mean. The cost of borrowing goes up when yields go up. All right? It's not directly correlated, but think of it like a domino effect. Eventually, when you have the 10-year go up, the 30-year yields go up, eventually that's going to trickle into mortgage rates, into loans, into credit lines, into operating lines of credits. Effectively, the shelves that these companies use, right? They use hundreds of millions of dollars known as shelves, these credit lines, operating credit lines that are extended to them. You think the costs on those debts that they have, these growth companies, because they're using this leverage to grow their revenue as fast as they can, you think the cost on that growth has gone down? No, it's gone up, right? It now costs more money to borrow $1, okay? So it's not a surprise to those of us who are professionals who've been trading for a long time, who've been in markets, okay, who've been on the institutional side, to be able to see why. Okay, so I'm not going to drag it out and take too long. In fact, just brief glimpse here. We see oil's gone up because OPEC agreed to keep supply relatively stable. That's bullish for oil. I said that, what's going to happen with OPEC is going to have a big impact. And here we are, a few days later from when I said that, here we are. It doesn't, it's not a big crazy level. It's not crazy to think that, oil could go to 70. I think it's the next stop with OPEC holding supply. If OPEC came out and said, you know what, we're going to bump up supply, I assure you oil would have dropped down to around 57, 56 level from the 60 area that we were. Gold continues to get hammered. Another, I would say, miscalculation in the market's sort of thinking and approach to this. As inflation goes up, potentially, as yields go up, what should happen? The gold, okay, which is usually seen as a hedge, usually seen as an inflationary hedge, usually seen as a store of value, that should also tick up. But the opposite is happening. Gold has been pulling back alongside markets. Okay, what has been happening though is the US dollar has gotten stronger, which is not surprising as yields get stronger, higher, more. As banks, prices, I would say the banks' stock prices go up, banks' revenues can increase. I'm not too surprised that the US dollar is ticking up. Okay, this is the US dollar index, not the US dollar compared to a specific currency, but the broader major currencies. All we need to see is that it's moving upwards. Okay, so that's a brief glimpse into the other asset classes that are out there. I'm going to quickly also run down and show you the year-to-date chart of the S&P 500, the S&P 500 index, SPY. Okay, it's still up about 4% year-to-date. Although we've pulled back, it's still up about 4% on the year. What's negative is utilities. Okay, XLU is utilities. Pharmaceutical and tech is relatively flat on the year. Take a look at the leading performers for this year. Energy is up nearly 40%. Energy-related stocks in the S&P 500, okay, are up nearly 40% year to date. Second leader this year to date is financials. Financials are up 15%. So both these two sectors are outperforming, okay, the S&P 500. A close third, very close to the S&P 500, matching it is the real estate sector, XLRE. Okay, so that's a brief breakdown on the different sectors of the S&P 500, the broader U.S. market. Now, I said that this is where we can go. 3760 still remains in play. You don't have to be a genius to understand that if we break below 3760, okay, hold on, because we could see 3700 next. No, I didn't bring up this line here, just didn't pull it out of my ass here, okay? Okay, there's a reason why, all right? Just like there was a reason why I said 3760, and you can see how important that level was, okay? So 3700 area is something you want to be cautious about if we break lower. I'm not saying it's going to happen. I can't tell the future. Some of you may think I can, but I can't. Okay, so I'm not going to go into the sort of thought process of us going below 3700. I don't see that happening this week. I mean, God forbid, at least, because that would be another 3.5% drop from this current Friday's close. Okay, to give you an idea, to hit the 3700 level on the index and the S&P 500, we would need another 3.5% drop. Okay, that would put us in the S&P 500 if we go to 3700 level about a 6.5% or a 6% pullback. Still not a correction territory. Remember, correction is 10% from the highs. Okay, if not this week, maybe next week. Remember, don't panic, don't freak out. Just giving a case by case sort of flow chart, or if A happens, B might happen. If B happens, C might happen, right? So if we break below 3700, I added this line this time around, okay? The 3740 area is another area that is critical. I'm not going to go into the thought process thinking that we're going to go down to that level, but if we did, okay, the market would be approximately 7.5% down from the highs if we get there. Okay, I'm not saying we will. And similarly, what I'll also do is outline with you in real time. Okay, don't need to do any complex math. I don't need to draw lines all over the fucking place like this, and do shit like this. I don't need to do shit like this, and do all this kind of nonsense that you see. Again, people like it, that's fine, but you won't see me doing that. Okay, I've been around this long enough to be able to tell you that I really feel the 295 in this area. I'm going to bring up the index actually. I'd rather do it on the index. Okay, don't use the NASDAQ index too much, but okay. So I'm going to do it on the, this is not exactly right. Damn it. That's the stock. Index. Okay, so I'm going to draw for you a little bit of a level here for the NASDAQ. Okay, remember, it's down about 8.5%. Okay, I feel a support level in the NASDAQ is right around here in the index level. Okay, just going to briefly mark it here, 12,100. Trying to get that here right. Close enough. Okay, maybe make note of this. Okay, maybe it factors in, maybe it doesn't. Okay, 12,100. Okay, just close enough. All right, this is an important level to keep an eye on. Okay, for the NASDAQ. If we go lower, okay, you know, the NASDAQ moves a lot more wildly. We've seen if the S&P 500 is down 1%, the NASDAQ's down 2.5%. You know, a 1.5 times move larger than the index of the S&P 500. So this thing can move a lot faster, of course, because tech is the biggest pullback. Tech is a large constituent of the S&P 500. So I think, you know what, if we break below that, you know, I definitely would not be surprised if we see this level here. Okay, and this level I'm going to draw probably in a red line for you. Okay, so the 1155. Okay, so 11,550 area. Okay, it's not exact. I apologize. I know it's not exact, but something that you want to maybe make a mental note of or keep in mind. Okay, these two areas on the NASDAQ. Right, flip back to the S&P 500, which is what I watch the most. Keep in mind, it's going to be dependent on yields. Okay, futures open tomorrow at 6 p.m. Eastern. I will be watching live, but yields matter the most. Okay, because if we see yields pull back, okay, if we see the 10-year pull back, go from 1.55 this week and stabilize below 1.45, 1.4, the market should move past this drop. Okay, if it doesn't do that, if the yields stay at 1.55 or worst case scenario go to 1.6, 1.65, I'm not saying it will happen, but if it does, we need to be aware of what can happen next. What can happen next? We can continue to see this tech-derived sell-off go lower. Okay, be aware, be prepared. What can you do? What can you do now, where we are now, without being able to tell the future and without taking these crazy-ass, random-ass guesses? Being strategic about it, looking at probabilities, you cannot go wrong taking starter positions in some excellent companies. I'm not going to, you know, beat this dead horse again and again. There's some amazing large caps that are discounted from all-time highs. I'm not saying they're great value, but they're good entry points. There's some amazing ones that you can consider. Okay, I share this live real time with my elite members. So I'm not going to come here and just give out anything and everything for free that people are putting their time, hard-earned money and effort in. Okay, so it's not fair to them, but I will say that there's some amazing opportunities, some solid tech stocks, amazing opportunities in large cap pharmaceuticals, in large cap consumer staples and consumer discretionaries. If you know what I'm talking about, if you know the language I'm speaking, it's not hard to find what I'm talking about there. Okay. With that said, you can check out some of my previous videos. You don't have to be a genius. Go back in the videos on my profile and take a look at the stocks that I mentioned. In fact, last week's webinar I did on Saturday, same time, mentioned a few. Okay. There's also a video where I talk about 6 stocks that I have over 700 grand in. Okay. Take a look at that too. More than enough for you to essentially dabble in and start positions in. Moving on. I've covered a lot so far. It's been about 30 minutes I've been yapping on. I want to take some questions, rapid fire questions. I want to really kind of interact with you guys. Let's kick things off. I hope there's not any too many questions above, but I'm going to start looking at them now. Please type in your questions if you have them. Please make them brief, concise, and you know what? Please don't ask me stuff that you can find off of Google. Time is of the essence. So let's kick things off. We'll take some questions. I will answer them. If you have any specific questions, the more specific, the more precise, the better. All right. So I'll give it a moment till I can see some questions coming in. And then we will wrap up after I've answered a sufficient amount of questions. Okay. Someone's asking TRCH. Where is that? Please, no small caps. Energy. You know what? This is not a good look for this. I'm not gonna go into this, but ultimately, it's a small cap energy company. I don't know too much about this. I haven't traded it. I avoid small caps, penny stocks, all that stuff. I will not go into that. It's a waste of time. So Aaron asked me, is there any way the 10-year yields in the market can go up in tandem? That's a great question. That's a great question. 10-year, fuck. Okay, so the 10-year, trying to bring it up. The 10-year yield, what can happen is we've seen, ultimately it comes down to sentiment. So there is a correlation between yields going up, markets coming down, but it's not tied to the hip. It's not one-to-one, right? We can see the yield go up or stay above 1.5, go at 1.6, 1.65, as long as the market is discounted. That's what's happening. It's the market is discounting growth. Discounting growth. That's what it's doing, right? Why? Because it's gotten more expensive to fuel growth. Why? Because the cost of borrowing is up, inflation could be higher, so on and so forth, right? It could also be a mix of profit taking, yada yada, right? So yes, absolutely, the yield can remain higher. Okay, it can remain high. It can remain, I use the word high because rates are still relatively low, but over the last year, it can remain at 1.6, 1.65, maybe 1.7 even. That's a bit of a stretch, but markets can also recover. It all has to do with the market discounting growth, then finding a floor. Okay, when the S&P 500 finds a floor, okay, and the yields have stabilized. Right now, they haven't stabilized. They've been going up. It's almost parabolic. The problem with yields going up is twofold. One, it's going up, and the rate of acceleration. That's the issue that the market has. Okay, it's going up too fast, too quickly, to the extent that the Fed chair Jerome Powell had to also chime in on it. And markets didn't really like too much what he said initially on Thursday. But you know what? Yes, to answer your question briefly, both can go up. It just has to come down to the markets finding a floor and stabilizing. Once growth is discounted, then the market can sort of think rationally. We can change the sentiment, and then markets can slowly recover from there on. Okay, but keep in mind, I don't see tech being at the forefront as it was. It could still be a leader. Okay, the tech stocks have done amazing over the last 5-10 years, of course, but I do see with yields being higher, if they remain higher, we may see recoveries in some of these great value companies that have been decimated. Okay, so we may see a resurgence in those. Someone's asking me, a few questions have come in since then. Palantir, this is a one that I have a relatively decent sized position. It's been butchered, but the 23-22 area looks very, very good in my view for a long position. Again, you have to trade according to your own risk and whatnot. The problem that the thing that broke this stock was Peter Thiel, the chairman, I think the CEO as well, or someone, just selling about $500 million worth of shares, right? That's not very confidence inspiring. And then you mix that with these growth, this is a growth stock, okay? It's a recent IPO. It's been a private company for quite some time, but it's a recent IPO. As you can see, it's in October, has had a great run up. And I'm not surprised by this pullback at all. We can discuss ad nauseum if this is overvalued or whatnot, but ultimately, this two things that broke it are, Peter Thiel selling about 500 million worth, plus the discounting going on these tech growth companies, right? With this pullback. So both of them have spelled pretty much a disaster, with the stock dropping, about 40%, maybe 50% from highs. Okay, so this is a key area. You can see what happened on Friday. Holy crap, look at that candle, right? Went down just to $19.99, give or take, and pulled back up to about $23, $24, right? So this is a good area to start positioning. I've had a position in it for a few weeks already, and it's in the red, but it's okay. I'm not sweating. I don't have a problem. Okay. Someone's asking me, am I still holding on to, am I holding on to token pay, the cryptocurrency? No, no crypto. I don't have any crypto positions. Um, am I seeing a tech rise because of stimulus news? So yes, once we see markets stabilize, I'm gonna obviously we're gonna have tech come back. It's not tech's not going anywhere. Okay, like these are major companies. They're not going under. They're not going anywhere. And of course we're gonna see a recovery at some point. The factor is when, how long, how deep does the sell-off go? These are all questions that no one on this planet has an answer, concrete answer to. So all we can do is do our best guesses, look at probabilities, look at looking at hedging ourselves, looking at dabbling in and getting our toes wet slowly, because we're never going to be able to get the bottom. We're never going to be able to get in the bottom consistently. So this is why I recommend get in some solid companies, get in and scale in. If markets go lower, that's fine. Don't set hard stops and get stopped out, because that's just a waste. Okay, get in slowly and average into these companies slowly, but with a plan. Okay, with that said, do I ever use as VIX as an indicator for a correction? Yes, we monitor the VIX index, okay, the volatility index, and I haven't had, I haven't taken a position right now. I had one in the beginning of the week that I closed for a tiny profit, but I did take a hedge on Friday. I took a hedge with calls on this. So this is the inverse S&P 500 ETF. So if the market goes up, this is going to get butchered. As you can see, it's leverage. Okay, it's 3 times leverage. So if the market goes up, this is going to continue to get butchered. But if markets tank, this will have sharp and large increases, and add in calls, which are leveraged as well, and then the potential for outsized rally is there. With that said, it's more of a hedge, and it's not a large position. If markets continue to go up, then this will get pulled back down, and that's fine, right? So I have done some hedging, nothing too much. What are good plays for times with high inflation? You want to go defensive stocks, right? Defensive stocks, meaning value companies, right? Think companies that you know and are aware of, and you use their products often. These are defensive companies. You want to buy at good prices. And I'm not going to sort of go into the weeds and details of it because it's a long-winded answer. But ultimately, pick defensive companies. If you have companies that are growth companies, they don't make any money, they have revenue, but they don't make any profits, those are the companies that are going to get slaughtered the most. The number one indicator to see if a company is defensive or not is, do they have positive cash flow? Do they have profits? Have they been operating for years and years and years? Do they provide dividends maybe? These are defensive, okay? What does someone asked me, airlines and cars are a good investment from now? I mean, airlines is a good recovery play, good recovery in travel, but you will notice some of them have already had a nice recovery. Again, this past week hasn't been ideal, but some of them have been recovering very nicely, leading it to the previous high levels before the pandemic sell-off. Okay, so Delta has been one that has come back quite a bit, not quite back to where it was around the 60 level, but these are good stocks if you have the time frame and the ability to take positions in them. I wouldn't go too large, but this is a recovery play. As far as cars, I mean, that's a different story. I won't touch on that. Is it possible to guess and predict where Suncor will go? No, Suncor is going to move with energy, and energy has been going up, right? Suncor is a direct pure play on energy, oil, right? So oil production. So if oil continues to go up, you can see Suncor will continue to recover, but there's no hard and fast area that it can recover to. Okay, we can't tell the future. Have I ever day traded? Someone's asking me. I have. Of course I have. But I'm not a day trader because there's no edge. There's no viable edge or consistency in day trading, no matter what someone tells you. Sure, you can make money, but guess what? You can make money doing a lot of things. You can also make money at Vegas. The problem comes in the consistency. There are a few that can do it, make money consistently and do it well. But the vast majority, nuh-uh. Forget about it. Okay, so I have day traded, but I don't day trade, you know, as a go-to thing. Okay, um, nuclear energy growth due to climate change. This is something I've been talking about, had mentioned. Um, I'm still kind of holding off for now. This is not the right environment to kind of dive into more up and coming frontier energy markets. Nuclear, is a more of a frontier market for energy. It's been out of favor, but I've kind of just held off on kind of looking at these positions with everything that's been going on the last couple of weeks. Okay. Someone asked me, do I think AT&T would be a good stock to play defensive with quite a high yield? So AT&T is a bit tricky one. It's something that's kind of been just languishing, and this is fine because people that have held it have been collecting the dividends, right? But it has a high debt load, has a higher yield. The yield on this is about 7%. But I think you can definitely take a position in it. I wouldn't go too heavy because of the yield only. So the last thing you want to do is only have AT&T as part of your, defensive company. No, you want to spread the love. You want to make sure that, it's not all in AT&T just because the yield is high. Okay. Someone asking me about Roblox. This is an IPO, recent IPO. A lot of people have been talking about it. Yes, I'm aware of it. I think it's way too frothy, way overvalued at the prices that it's going to be released at, and I have no doubt that once it IPOs, it's probably going to rocket, and even less of a reason to get in when it's on the secondary market. So this is another, Roblox is another growth stock that once it does release, I'm not surprised it's going to be very, very frothy valuation, and I personally do not, participate in IPOs once they're listed until I see an opportunity, right? So Palantir is one recent IPO that I got in on when I saw the opportunity, but it's not common for me to trade them, especially once they just get listed. So someone asked a good question: has the market already priced in the stimulus? For the most part, yes. For the most part, yes. Yes, it's gotten confirmed just recently, but overall, it's priced in. We are not surprised that it passed. It's not a secret. We've known that it's been in the works for some time. It just had to go through the bureaucratic and political process, and here it is. It's been approved, and I don't think it's going to be too big of a factor like previously. I remember back, middle of the year, Q3 and Q4, it was a big deal that the stimulus passed. It was a different stimulus, but those were the first, and we needed that. This one is a lot, I would say, it's still needed for many people, I understand, but it's a lot less critical. It's a lot less detrimental to be passed. It's of course the politicians in Congress and the House has seen it as being important, and that's fine. But it's not as big a deal as stimulus was last year. Okay. So yes, I feel like there's a lot of opportunities that I think you should look at in the defensive sector in good consumer staples, consumer discretionary. Money will be flowing. It's not, you don't have to be genius to understand supply and demand, that tech stocks have been pulling back. Why have they been pulling back? Because there's more supply, more people selling, these tech stocks, maybe even shorting, than there is people buying, right? So when that money is leaving the tech sector, where is it going? It's either going into cash, either it's going into different asset classes. But we do know one place it's going. It's been going into value plays. Now, the word value stock means many different things. It's not a guarantee that it's going to continue to go up, but there are some great opportunities in companies that have fallen out of favor. Not because the company's no good, they've just fallen out of favor because everyone was going for the tech stuff. Everyone was going for EV stocks. Everyone was going for these high-flying stocks. But now that that's kind of ended, with many of the people getting their asses handed to them, we are seeing a rotation into these value stocks. So I would definitely keep an eye on them. Okay. So understand that it's a great market environment for those of us that want to buy great companies at amazing prices. Okay, we saw this back in in March, and I didn't try and pick the bottom. No one can reasonably. So I highly recommend it, just like what I do now. I recommend what I recommended back then: taking positions slowly but surely, getting in, scaling in, averaging in. Don't wait for the bottom because no one knows. In fact, as I've said before, many people were waiting for a crash because they missed the bottom and they kept waiting, and the market went up and up and up. So more money had been lost waiting for crashes than actually being a part of in a crash. Okay, so don't just be someone who's sitting on the sidelines waiting. Okay, participate in the markets, give yourself enough time. Don't panic out. Don't sell just because something is down. You haven't lost the money just because you're down on the stock. Okay, the position is still open and it can recover so long as you hold great companies. If you're holding speculative nonsense, overvalued, trash, hype, meme stuff, then you know what I mean. If the money goes poof, then so be it. You had to get in knowing that, right? So, last question I want to ask is: with financials, institutions, companies adopting Bitcoin, or will they just make their own coin like how JP Morgan might be doing? Yeah, crypto. I remember back in 2017, when crypto was around 20K, everyone was talking about crypto, and all these financial institutions were opening up trading desks. Goldman opened up a trading desk, and everyone was like, yeah, we're going to be utilizing blockchain in our stuff, blah, blah, blah. Nothing really came of it. Ultimately, I think whether JP Morgan creates their own coin, it doesn't really fucking matter. What Bitcoin is still going to be the standard, the gold standard, so to speak. It's not that hard to have your own centralized or decentralized token or coin. So you know what? It's a question that's very open to speculation. I don't see anything happening at the moment. Okay. SPGs. I want to mention Corsair, SPG. A couple more questions. Disney is also coming up. Disney, I think it's a bit of a conundrum because this is one of the stocks that has done extremely well since the pandemic, and is holding really well, has a lot of relative strength throughout this drop. I think you have to believe in the company. You have to be a long-term holder for this. Okay, I don't personally see a trade in Disney, but for someone who wants to hold it for many months and even years, then sure, that's fine. As far as SPG, Simon Property Group, this one is a REIT, okay, that has recovered nicely, and something that I have traded and invested in. I think there is definitely some upside with reopening coming in, but you have to be careful because this company has a lot of exposure to commercial properties, has a lot of exposure to retail plazas and malls and such. And of course, we know that that isn't the same anymore, and I don't think it's going to be the same even after this pandemic is long past us. The whole shopping landscape has changed. Malls will still be around. These plazas, large plazas, strip malls will still be around, but not at the same level. So, SPG is kind of getting to its pre-pandemic price level, right? March last year, March drop. So, it's not, I would say, the best entry, but if you feel like you can get back to pre-pandemic levels, then it's a good entry right now. Just I wouldn't go too big on this. The yield is like about 4.5%. It's not the greatest. It's still a bit risky. Allocate some money to it, but just not too much. Okay. Last question. Corsair, CRSR. This is a good recent IPO. It's been brutalized, of course, over the last few weeks, of course, because guess what? These kind of companies are growth stocks. Recent IPOs mostly looking to increase revenue on a multiple standpoint, but of course, they don't really make much money, if at all. So this is a good stock. I think just let the bleeding stop. I think you have to give it some time because, of course, Corsair and their products, are obviously they have a diehard fan base, especially if you're a gamer, and ultimately, it can recover. Just know that this is a speculative trade. This is not known as a value play or a long-term hold or something like that, right? This is a more speculative play. It's a growth stock. Make sure the bleeding stops before you really kind of take any weight in this, okay? With that said, thank you, everyone. We've been going for nearly 50 minutes. I appreciate everyone chiming in. I appreciate, you're getting on, your support. participating in the chat room. I apologize if I skipped or missed some of your questions. It's a bit hard to keep going while answering questions on the fly. I hope you find these type of live webinars and recaps and Q&A sessions helpful. Please subscribe. Please subscribe to this channel. There's a lot of garbage out there. I would really appreciate your support. Share the channel, share the videos, watch the videos. A lot of people want things that are free, that cost nothing. Well, this is it. I give a lot of content, a lot of insights, a lot of knowledge at no cost, with no commitment. So people want it, I give it. It's just a shame that some people still don't go for it. Some people don't put the time in, but they want stuff. But when I give it to them, they don't put the time in or the effort in. So it's a shame. But you know what? Hopefully we get some traction. More people start paying attention, watching, and learning. With that said, I appreciate you getting on. I appreciate all of you, each and every one of you. Especially, of course, I can't thank my elite members enough. I can't talk the support that I get on social media, Instagram, so on and so forth. You are all wonderful. I appreciate you all. Keep kicking ass. Be safe. Don't be afraid. Understand that the markets are there to help you grow your wealth. Always, always increase your time frame. Don't fall for FOMO or fear. Don't chase. Stay away from garbage stocks, and you will be fine. Okay, mix that in with the guidance that I provide, my team provides, and our offerings on learning how to become a proper trader. You will be fine. Okay. With that said, all the best. Have a great rest of the weekend. Ciao.